Hello and welcome to the show. Tracking economic policy is no easy task. Going behind the headlines and getting one's head around the issues can be even more demanding. This show is an attempt to simplify things and put important issues in perspective for you. We engage leading voices in their respective fields and attempt to better understand economic issues that affect you on a day-to-day basis. This is Policy Watch and I'm Athar Khan. We've zoomed in on two issues this week. The hot demand for gold in the country that started in early 2011 but seems to be ebbing at the start of the new year. We'll discuss the import trends, the Indian obsession for gold, its effects on the country's current account deficit. The other story is the state of the banking sector in the country. Will 2012 be a better year for banks? Does tremendous pressure on margins coupled with growing non-performing assets or NPAs warrant a change in strategy? We'll talk about all that and more with our special guest, the Deputy Executive Editor of the Hindustan Times, Rajesh Mahapatra. Welcome to the show. Before we go into the packages and the stories that we've lined up for this week, let's talk a bit about 2011. A year that was supposed to have been not very good for the country economically. There were more low points than high. Would you agree?
Well, on the economy front, one can't think of highs. The only highs you can think of is interest rates went high and higher and higher, and so was inflation rate. And if those were the kind of highs that you would like to see, then I think 2011 is a year one would wish you would not remember them for any highs. On the low side, yes, we started off on a good note, but then we were done in by inflation first, then came the rising interest rates, and of course the global uncertainties that only got from bad to worse. So we have gone from good to bad. The one way you could look at it is we went from good to bad, and the worst is about to come.
You spoke about interest rates. There is a feeling largely in India Inc., and they're expecting the market as well, that RBI might just go on easing rates post-March. Do you think it'll happen in March, or do you think it'll take more time?
Yeah, I think we are done with interest rate hike cycle. Now, whether it happens now or in March, it's just a matter of time. It doesn't hold any significance now at a time when everything has gone into a slowdown phase. So now people's confidence has taken.
So you'd say the worst is over of the rate hike?
The worst is over about the rate hike, but the best hasn't begun.
Right.
The better hasn't begun.
That's fair point. We'll go into a story now. We'll discuss gold first. With inflation becoming a part of our daily lives in the past year, an increasing number of Indians have found an ally in gold. In the third quarter of 2011-2012, Indian gold imports touched new highs, with India being the highest consumer in the world after China. India's love for gold is not restricted to jewelry either, with households investing in gold bars, coins and what have you. To help us better understand this gold rush, the Policy Watch team filed this special report.
India traditionally has been fascinated with gold. Jewelry and adornments aside, gold has always been considered a sign of prosperity and status in Indian society, especially with the middle class. The consumption of gold has been a part of the Indian ethos for as long as one can remember. If figures by a leading global research firm are to be believed, the Indian obsession with gold continues unabated, with Indian households owning $950 billion worth in gold. According to global research firm Macquarie, 8% of household savings was held in gold in 2009-2010. India was the highest global consumer in tonnage terms. Indians hold 18,000 tons of gold. Notwithstanding the 64% cumulative rise in gold prices in rupee terms between Jan 2010 and September 2011, gold consumption in India in volume terms, including jewelry and net retail investment, is still holding strong. And with gold evolving as an object of value more than as an adornment, rising gold prices have also contributed towards increasing Indian households' perceived wealth. Although during the quarter ended September 2011, gold demand in volume terms declined 23% over last year. This was mainly due to a sharp depreciation in the rupee, high gold prices and inauspicious times according to the Hindu calendar. Will adversely affect the current account deficit, which going by conservative estimates could touch 3% of the GDP. Incremental gold imports alone will add close to 1% of GDP to the current account deficit for 2011-2012, taking the deficit close to 3.5% of GDP. Domestic gold prices have risen by 32% in 2011 thanks to the global financial crisis and a weak rupee, amidst concerns that the government's inability to arrest a widening fiscal deficit could drag down equities and trigger foreign fund outflows.
So you saw the report that we had filed. My first question to you would be, last year India saw this so-called gold rush. What were the reasons for it? Did inflation play a really big role because people wanted to buy a safe investment, which gold is traditionally in India?
Let me take the different route to explain this. When we say what was driving the demand for gold or the buying of gold, what are the factors that actually drive demand for gold? And they're not very different from what are the factors elsewhere in the world. People look at gold as an instrument of investment. So when you have stock markets world over sliding, volatile, people take recourse to gold. You saw that happening across the world. You know, some of the leading investment bankers, some of the leading funds bought heavily into gold. Some of the tycoons in the investment world, like George Soros, you name it, they bought heavily into gold because then gold becomes a safe bet. Then you had other than the stock market, people look into real estate. And we know real estate, what has happened in the last 1 year.
Also very volatile.
Very volatile. The prospects are not very good. The memories of 2008 and after what happened came back, so people rushed to gold. The third factor was oil and other commodities were not as attractive as they looked in earlier years. So gold became a natural choice.
And oil prices were soaring also.
Yeah, but in oil futures, people, the outlook was very uncertain because, your three of developed blocks, US, Europe, and Japan, you were not very sure which way they were heading to. The other factor is dollar. People invest in dollar. And the euro crisis had its fallout on dollar in the initial part of the year. And people were also not so sure about dollar. So people moved to gold. But those were the global factors, and they remain the same in India, and they work with the same time. If you come back to India, there are two other factors. There is this thing called the Indian obsession for gold, the Indian women's obsession for gold. You can't get away from that.
Something that's very well documented.
You can't get away from that. Gold prices rising, falling. There is a certain amount of demand that is always factored into the Indian system, and that will remain there. And that's something which will probably take up when the clip that you showed talks about current account deficit and all, and what is going to be the scenario. We'll talk about that. Yeah. The other factor that also one has to bear in mind that we are the world's largest consumer of gold. We are the largest stockist of gold, but we produce nothing, next to nothing. We produce only the 3 mines that are operational in this country produce only 0.5% of what we consume. So we have to import. So what happens to gold prices here, what happens to the demand for gold here is always driven by what is happening to gold elsewhere in the world. Yeah. So that's I would say that's the perspective, that's the framework through which we need to look at what happened in 2011.
Right, but now if I could just interrupt you, we'll go into a short break, but we'll discuss the effect on the current account deficit. Also, the gold demand is easing up now. We'll take a short break. We'll come back, discuss everything gold after the break. Welcome back. You're still with Policy Watch, and we're still discussing gold. Now, gold imports, the demand for gold, when this year started, drastically went down. If I have my figures correct, gold imports in India plunged by 56% to 125 tons. Is the only reason for that because gold prices are soaring elsewhere?
I think the rupee had a lot to do with that. The rupee depreciated very rapidly through December. And
I think it's the worst decline in 10 years. Yeah.
And that's it's sort of, I think, in 1 month alone, it declined close to 6%. So, gold prices, import prices go up by an equal margin. The other factor would be it's about expectations that are factored into 2012. You spoke about inflation, whether inflation is linked to gold prices. Well, there are studies which show the correlation between inflation and gold prices are very weak. They are not historically borne out. Whereas the correlation between gold and dollar is rather strong.
But some people would say, increase of gold imports does affect the economy.
I do not know if there are studies that really back it up, but
you don't agree with that?
Yeah, because the studies that, there are well-documented studies that show that the correlation is very weak. The correlation is very strong with dollar, and that perhaps explains as to why the demand for gold is easing up. One could be the rupee, two, the dollar going strong, and most people, if you look at US job loss data, things are not as, US is holding out better than what it was expected to do. And that has a positive impact on dollar. And if dollar continues to hold its ground, it is unlikely that gold, because when dollar weakens, gold prices rise. When dollar strengthens, gold prices are likely to weaken. My guess would be in 2012, most investors are expecting that gold prices would somewhat trade a steady ground. They would probably hold out between the $1,900 to $2,200 range, which means, domestically we could look at a 26,000 to 29,000 per 10-gram range. And that's why people are saying, why buy now when the rupee is down? Wait for some more time. Let's see how it plays out in the first quarter of 2012.
We had a guest on the show last week, and he did suggest that increasing amounts of gold imports do affect the deficit of the country as well. Now, some people, especially the gold lobby in India, have said that the government should import duty on gold imports. Will that help at all?
Well, the government also has its own compulsions. It needs money, and it needs money more than it did yesterday. It needs them more today. And and the gold merchants have their valid reason. The moment you have, the one way to ease up demand is, to brighten up demand is they would always ask for a cut in duty. Both sides have their own views, and both sides are justified in their own ways.
So let's talk about the deficit for a bit as well, because there is a school of thought in the country that says that the more gold imports that we do get into the country, it will affect the deficit of the country. It will widen the deficit of the country. In the best of times, a country like ours with a deficit of 3.3% is okay. Do you think, to what extent do gold imports really affect the current account deficit of the country?
Look, like any other imports, when your own currency is weakening and imports are rising, it will definitely affect your current account deficit, right?
CAD, yeah.
And anything that pushes up your current account deficit is a matter of concern. So what do you do with that? Do you take, as a government, do you take measures to discourage import of gold? Well, gold is one undesirable import. If you could say so. There are imports you make to, let's say you are importing a capital machinery, which is going into a factory which produces goods, and they are exported out. So there is, that balancing out. With gold, none of that happens. It just comes in and stays here. It doesn't go out. We don't export much of gold, right? So, well, there will be a stronger argument to do something to discourage gold. But our experience shows, has it helped us? We had a ban on gold, in many ways a ban on gold for several decades. And we had this fantastic trade of gold smuggling. We
don't want the same to happen again.
We don't want to go back into the past, right? So I think as a government, there are better ways to deal with the current account deficit than pick up something and say, no, I'm going to ban it.
Let me throw you another theory. We saw in the packet that we sent, Indian households hold a large amount of gold. Instead of looking and crying black money abroad, can't the government look at the amount that is invested in Indian households, gold? Right now, that's not happening. I'm not saying the government should issue a diktat and say, we'll capture all the gold there, but somewhere along those lines, can't we look inwards rather than look outwards?
Yeah, surely there is a case to look inward. And if you really go after black money, maybe you will uncover a lot of unaccounted gold, and that would do a lot good to the nation.
Right.
I mean, nobody denies that. I think we have more black money stored inside. But I would say don't go back to the 70s and 80s. All that you would end up doing probably give some newer scripts to our Bollywood. They will probably come back with all those gold smuggling scripts, of the sea shows.
And God knows Bollywood needs good scripts, if
so
anything.
if you want to help Bollywood, you might sort of look at
Okay,
the
the last point on gold we'll touch before we move on to the other story is, what about gold loans that are rampant in the country, virtually on tap in the country? Is that good for us?
I mean, there is nothing bad with gold loans. There is nothing bad. There is everything bad with loans so long as they are not regulated properly. If any system that is regulated properly, there is nothing. I mean, gold loan is just like any other loan. If you have a system where it is well regulated, there is no harm. The concern that we have in this country, that we have way too many institutions that are into lending money against gold, and the concern is that they are not regulated.
Right.
So tomorrow they go away, the fly-by-night syndrome. If that recurs, you could have a crisis.
Fair point. Regulation is very important. I take that point. It's time to move on to our next story, which is about the banking sector in the country. The banking sector in India did not have a great year. During 2011, Indian banks faced a dual challenge. A series of key interest rate hikes by the RBI hurt the margins of most banks. And with non-performing assets or NPAs burdening banks ever so rapidly, especially in rural banking, we'll talk about what banks are in for in 2012. But before we do, here is a special report.
2011 saw the Reserve Bank of India's monetary stance turn increasingly hawkish. Grappling with skyrocketing inflation, the central bank went on the offensive against price rise and hiked key interest rates in rapid succession. While the efficacy of these measures against inflation is still hotly disputed, the rate hikes did have an impact on economic as well as credit growth. As corporate balance sheets started to get hit by monetary tightening, the central bank also increased provisioning requirements for non-performing assets. And the forecast for 2012 does not look too rosy either. According to banking experts, the Indian banking sector may have a subdued start to the new year with a growing burden of bad loans and restructured assets. According to the Reserve Bank of India data, the annual pace of credit expansion declined to 17.1% in December 2011 from 23.9% a year ago. NPAs were also on the rise, with total NPAs for some major public sector banks being 23,074 crore rupees for the State Bank of India, 2,793 crore rupees for the Indian Overseas Bank, 4,379 crore rupees for Punjab National Bank, 4,357 crore rupees for Bank of India, and 3,623 crore rupees for Union Bank of India. Increase in costs of deposits and a fall in credit growth will also see bank margins under pressure. Volatile movement in bonds in early 2012 is also a factor that could affect provisions of banks in the future. But India's largest lender, State Bank of India, is confident of bucking the trend and expects its net interest margin for the third quarter of 2011-2012 to be 3.75. It is also imperative for banks to come with some solutions to shore up their lagging performance. Given the high cost of borrowing in the current scenario, banks need to evaluate their deposit portfolio. For the time being, all eyes are on the RBI, which is expected largely to ease the tightening cycle. Banks would be keenly waiting for January 16th, when the RBI meets next to decide on easing rates.
Rajesh, it's time for a short break. We'll discuss that story and more after the break. Don't go anywhere. Stay with us. We'll be right back. Welcome back. You're still with Policy Watch. Rajesh, let's talk about banks and the banking sector, and especially increasing NPAs and increasing the deteriorating asset quality, as the finance minister called it. What do you think the banks can do actually to get out of that slump and manage their NPAs more effectively?
There are no easy answers. It's a serious issue. The NPA ratios have grown very fast. If you sort of, for our readers, non-performing assets or bad loans as proportion of the total loans that banks give, and that happens when your credit growth lags your
Slows
growth
down.
in bad loans. So, and it's blame it on the economy. Because of the slowdown, credit offtake, and of course, the sustained rise in interest rates, 13 times or 14 times.
Since March
the
2010, I
interest
think it was
costs
13 times. Yeah.
Interest costs have gone up by nearly 20% ever since RBI started monetary tightening. And that has had an impact on credit growth. In the last 6 months, between March to September 2011, your credit growth was around 19%, whereas your bad loans increased by about 30%. And that has pushed up your NPA, gross NPA, to about 2.8%.
So you're saying banks need to avoid this skewed ratio?
Yeah, the only way they can do it is by doing something to speed up the credit growth, because bad loans are rising and they would probably rise at the same rate. So the only way you can sort of keep NPAs under control is by pushing credit growth. Can you do that? It's not easy, because when the economy was doing well or when there was demand for loans, your interest rates were too high. Now you have gone into a slowdown phase, and there are all kinds of things now playing out in the market. Even if you start cutting back interest rates, it is not easy for companies to now get back to a borrowing spree and resume their investment.
Let me jump in there. Fitch, the rating agency, says for the next 9 to 18 months, there will be a dip in industrial activity. It will be a moderating effect on industrial activity. Now, what does that mean for banks, especially the banks that are giving loans to, say, infra projects, like you mentioned during the break, power projects as well as telecom projects? Won't that have a bad effect on them?
It will, because these projects could get delayed, and these projects delays would then have a bearing on the loan repayment schedule of these projects, in which case banks will be forced to get into restructuring debt of these projects, as they have done in the last 1 year. And there we have discovered that the debt restructuring component for power and telecom sector has gone up from 5% to 8.5%. That is a big concern. I have a bigger concern. What once is happening, this is the time actually when you need banks to loan out money. You need banks to go aggressive on the loan front. But this is also a time, because of whatever has happened now with NPAs, banks are likely to go very conservative on loans.
So the argument you're saying is growth versus sustainability and finding a balance there.
And it's a difficult balance to find.
It's a very difficult balance to find, that's what you're saying.
Yeah.
And you think banks have the capability, and especially I also want to make a point about Basel III. RBI has introduced Basel III norms now. That would mean banks have to raise more funds.
Set aside more capital. Aside more capital. I think there is a serious case to defer those norms. I don't think we are in a situation today. See, look, Indian banks, they are not going to get into any big crisis mode. 50% of their capital is owned by the government. There is that sovereign guarantee. Most of their businesses come from interest fees. So they have a very low risk profile. Even if NPAs rise, we are not getting into a crisis in the banking sector. However, if NPAs rise, we are going to have serious consequences for the broader economy's recovery. And that's where the concern that I was talking about are the small and medium enterprises. Right. They are going to get dried up of funds. Banks are going to shy away from them. Those guys are already under strain. The big corporates, big companies, big factories, to whom they make up as suppliers, their payments are getting held up because those companies do not have enough
and
cash.
Effectively, MSMEs are the future of the economy in India.
They are the ones who would perhaps you would have relied on them to lead you out of this slump. They were the ones who you would have sort of bet on to lead the next phase of growth. Right. And they are going to be in a bit of a tight spot.
Right. Let's talk about NIMs for a bit. Net interest margins under tremendous pressure throughout 2011. What is your outlook for NIMs during this year? Starting, say, next fiscal.
Well, I think they would continue to be. I don't see things getting much better there. If not, they add to that strain. I think it's not going to improve significantly for the simple reason that you have already locked in a lot of deposit rates are high, and you have done. There is a bit of disruptive impact that your savings rate deregulation had. It pushed banks into a competitive phase. So where people, each bank in response to the other bank kept raising their interest.
So rate wars basically.
The rate was, deposit rate was happened. And now that if you were to see, in order to drive the economy back into a recovery phase, if you were to look at interest rates coming down and deposit rates are also, somewhat in the short term a downward visit. So I don't see net interest margins throwing up. So in terms of, if you're talking in terms of what would that mean for banks' profitability, I don't think banks' profitability, the outlook is very good.
Rajesh, we are completely out of time, but before we go, very briefly, under 20 seconds, if you could, any positives that you see for the banking industry, considering the fact that the banking bill is stuck in limbo, any positives that could be there for the banking industry 2012?
There was a message for the banking sector and for the government that regulates a lot of those banks. I would say, while you be careful about risky assets, it is also time to take some risks.
Right. We have to end that show on that note. As Rajesh said, it's time to take some risks. Growth versus sustainability is the key takeaway, and banks would have to balance that in the coming year. That's the key takeaway from the show Policy Watch today. Thanks for watching. Till next time, when we see you again, goodbye.